All right, let's get into it. Today, we're not just going to be about crunching numbers. Nope, we're talking about something way bigger, building financial integrity. This is all about creating a system of trust, One that's reliable, accurate, really the foundation of any healthy business. So let's dive in.
So I've got a question for you, and I want you to really think about it. How solid is your financial foundation? And I'm not just being dramatic. A company's financial health, it's not just some number on a spreadsheet. It's the ground everything is built on. Every decision, every strategy, every single plan for the future. You can't build something great on a weak foundation, right?
Okay, picture this. Think of a company's finances like a giant Jenga tower. It's this magnificent structure, right? Every transaction is a block, carefully placed. And when it's all done right, that tower is solid, it's impressive. But what happens if just one block is off? Even a tiny little error, one wrong number, and the whole thing gets wobbly, unreliable. And eventually, it can all come crashing down. But hey, it's not all doom and gloom. We're not just sitting around waiting for the tower to fall. We've got a blueprint, we have a whole set of tools to make sure our tower is built to last. I like to think of it as a financial detective kit. It's designed to hunt down those discrepancies, keep things in order, and build that rock-solid foundation of integrity. So today, let's unpack 3 of the most important tools in that kit.
First up, we've got bank reconciliation. The best way to think about this? It's like a high-security safe deposit box for your cash, and it needs 2 keys to open. One key is what the company's own records say. What you think you have. The other key? That's the bank's official statement, what the rest of the world says you have. Both keys have to match perfectly to know what you really have. It is the ultimate checkup for your most important asset.
All right, next tool in the kit, control accounts. So imagine you're driving a car. You don't need to watch every little gear turning, right? Or every piston firing. Of course not. You just glance at the dashboard to see your speed. A control account is exactly that, but for your finances. It takes like thousands of individual transactions, say every single customer invoice, and boils them all down to one clean, simple number on your main dashboard.
And our third tool is something I like to call financial time travel. It's officially known as the correction of errors. Basically, it's the process for going back in time to where a mistake happened and fixing it. The point isn't to rewrite history, but to correct the record of history. That way, your financial story stays true and accurate from day one all the way to today.
So let's go a little deeper on that first tool, bank reconciliation. The whole point here is to line up 2 completely different views of your cash. On one side, you've got the company's cash book. That's your story, your internal log of every check you wrote and every deposit you think you made. And on the other side, the bank statement. That's the external, objective truth of what's actually cleared. And here's the thing, they almost never match up perfectly at first glance. And that's where the detective work really starts.
The process itself is basically a hunt for the truth. It's pretty logical. You start by comparing your records to the bank's, ticking off every transaction that lines up. That's the easy part. The real work is hunting for the differences. And these aren't always big mistakes, A lot of the time it's just timing, like checks you've sent that haven't been cashed yet, or maybe a surprise bank fee you didn't see coming. Once you've found all these little items, you adjust both sides until, bam, they meet at one single verified number, the true cash balance.
And that is the goal. It's all about getting to that equilibrium, taking 2 different stories about your cash and through some careful digging, getting them to sing in perfect harmony. When that scale balances, you've got certainty. You have a number you can absolutely count on.
Okay, now let's switch gears to our second tool, which tackles a totally different challenge, the problem of scale. Think about it. As a business grows, it suddenly gets hit with an avalanche of data. We're talking thousands of individual sales to customers, hundreds of purchases from suppliers. Can you imagine trying to manage every single one of those tiny details in your main financial record? It would be total chaos.
And that's where the control account comes in as this really elegant solution. It's that summary, that speedometer we talked about. It gives you one clean number for something like total owed by customers. But, and this is the really critical part, that one number on your dashboard has to equal the sum of all the individual customer accounts in your detailed records. If it doesn't, a warning light flashes. You know instantly that there's an error somewhere that you need to go find.
But what happens when you do find an error? Well, not all mistakes are created equal. Some are so big, so important, they're called material errors. And the official definition is pretty wild. It basically says an error is material if knowing about it would have changed a reasonable investor's mind. Like it's a mistake big enough that it would have made them decide to buy stock when they didn't or sell when they held on. It literally changes the whole story. The stakes here are incredibly high.
So how in the world do you fix a mistake that big? Well, there are two main ways, and believe me, the difference between them is massive. We've got the big R restatement and the little r restatement. A big R means you have to formally go back and reissue your past financial statements. It's a huge public deal. You actually have to file a special form telling the world, hey, everyone, you can't rely on our old numbers anymore. It's a big red flag. A little r, though, is way quieter. It's for an error that was maybe small in the past, but if you fixed it today, it would mess up this year's numbers. So you just adjust the old numbers for comparison inside the current year's report. No big public alarm bells. The difference is just night and day.
So we've looked at these three pretty powerful tools, right? But the key is they don't work alone. They're not just separate items in a toolbox. They're interlocking building blocks. And when you put them all together, they create this really comprehensive system that's designed to build and protect one thing: trust in the numbers.
You can think of it like a multi-layered system of defense. You've got control accounts acting as the organizers, taking that massive flood of raw data and turning it into clean, manageable summaries. Then, your bank reconciliations are like the guards at the gate, constantly watching over your most important asset, cash, and verifying it's all there. And finally, error correction is your specialized cleanup crew with a clear, transparent process to fix any mistake that might have slipped through. Altogether, they create this powerful data pipeline that takes total chaos and turns it into reliable financial statements you can actually depend on.
And all of this work, all this structure and discipline, it leads to what I call the integrity payoff. This is the real benefit, the whole reason why getting these principles right is so incredibly important for any business that wants to stick around.
And this really is the main takeaway. Financial integrity isn't just about being right on a specific Tuesday afternoon. It's about being reliable, day in, day out. See, anybody can get a calculation right once, but a business with real integrity has a system that produces the right answer consistently. A system that everyone, stakeholders, investors, you name it, can trust without a second thought. And that kind of reliability, that's priceless.
So I'll leave you with this final thought. When you look at your own business, or maybe the companies you invest in, are you just looking at the final numbers? Or are you looking deeper at the systems that create those numbers? Is that financial foundation just a simple shack, or is it a fortress? Is it built with integrity? And is it built to last?